Hi, good morning, everyone, and welcome to the Development Finance Today virtual roundtable in partnership with specialist lender Roma Finance. My name is Karen Schroeder. I'm the Managing Director of MediaNet, a publisher of online titles Development Finance Today and Bridging and Commercial. And this is our weekly virtual roundtable series. We partner with a different sponsor every week to bring you a live discussion in which you can participate by asking questions and getting answers, or you can just sit back and watch. We will also publish a handy article next week that outlines the highlights from the discussion, as well as the full session in video format, should you wish to share or refer back to it. I'm delighted to be joined by Scott Marshall and Samantha Williamson, both from Roma, who will be shortly introducing themselves along with our excellent panel of brokers. It's great to see some familiar faces as well. Laura, I must note that you're becoming a regular in my living room / at-home office space, so welcome back to our screen. So first, let's intro our topic for today, which is underwriting and operational challenges in heavy refurb and ground-up development finance. Since the start of the year, there have been reports of heavy refurb requirements surging as investors seek to maximize value on existing assets and those that they've set their sights on. Hailed is indicating strong market bounce back. This increase has been helped along by the stamp duty holiday, a rise in holiday lets and work from home conversions, and the recently extended permitted development rights, among other influences. However, this market is susceptible to supply chain issues, given its relatively short lifespan when compared to ground-up schemes that are typically considered over 2 or more years. We'll be discussing the weight of these external factors on both types of finance, as well as the distinctions that need to be made when underwriting each. There is huge emphasis on determining reasonable timescales for builds at the outset, but how is this assessed by lenders and brokers, and what exactly is deemed reasonable in the current climate? Interestingly, half of last week's virtual roundtable attendees wanted to hear about ground-up development next, so we're on the money in terms of current sentiment, and I'm looking forward to hearing the panel's views on this important area. Without further ado, let's begin the introductions. Sam, I'll start with you.
Okay, thank you. So I'm Samantha Williamson. Been at Roma for, it's my 3rd year almost. Had 26, 27 years in the banking and finance industry. I know I don't look old enough, but it has been 26, 27 years. We've always been property-based lending. Worked for a number of high street banks, building societies. I've worked peer-to-peer. I've worked for other bridging companies. I've even done some broking over the years as well. And I'm also a family of been in the construction industry as well. So I've done a lot of flipping properties, and I've probably got 5 properties that I let out. So I've sort of got hands-on experience as well. So yeah, it's quite a range of stuff that I've looked at over the years. You know, specialist lending, commercial lending, investment properties, and of course ground-up developments that I specialise in as well.
Thanks very much, Sam. Scott?
Morning, everybody. Thank you, everybody, for joining Roma's roundtable today. And I'd like to include, obviously, Kim, Laura, Dave, Peter, Cameron for setting all of this up, and Sampa as well for taking part. Look, I'm the founder and the MD of Roma Finance. We have a very, very simple mission in business, and our mission is to help our customers create wealth for themselves and their families. That's what we do. And what we do is we see ourselves as partners of our customers in terms of making a success of the projects that they do. So we try and back people who are using our money to make money out of property transactions. That's what we do. The whole culture of the business is set around trying to find ways in which we can add value to customers and what they do. As a business, we are an institutionally backed lender. We've got 8 different funding lines, and we can come on to that a little bit later. But what that does is it enables us to be incredibly flexible around what our customers' needs are, because we've always got a solution to fit.
Thanks a lot, Scott. Dave, over to you.
I think I'm very similar to Samantha in the fact that 20 years or over 20 years now working for high street lenders I'll mention Lehman Brothers, but maybe I shouldn't mention Lehman Brothers because it's not something you want on your CV at this moment in time. But then I set up my own brokerage in 2007. Very grateful. We sold that to Key Retirement Solutions in 2014. Then I joined Finance for Business, and recently, only 2 weeks ago, was appointed as CEO of Finance for Business to drive that business forward, something I'm quite humbled and proud of, but great organisation to work for. But yeah, we've been in that specialist finance arena now for over 15 years, so we understand development, we understand bridging, and we understand the commercial mortgage space as well. Quite an exciting place to be.
Thanks, Dave. Kim?
Yeah, morning everyone. I'm the Managing Director of Vibe Finance. We're very much a specialist mortgage brokerage, so any type of investor finance, including ground-up developments and heavy refurbishments, working with the likes of Roma. So really looking forward to the conversation on here today. Prior to setting up Vibe, I guess we're still relatively new. We've been going around 3 years now through Brexit and COVID. But prior to that, I was a lending manager in the specialist sector. So very much utilising the lender background into what we do today.
Morning everyone, my name's Laura Toke, I'm a broker at SPF, and as Karen says, I've done so many of these roundtables recently, I'm sure you're all sick of me, but yeah, I'm really grateful to be here today. Thank you guys for putting this on. I think it's a really interesting topic to talk about development finance and heavy refurb over the last 12 months, because it's definitely, you know, been heavily affected by the events over the last 12 months. And for those of you who don't know who SPF are, we're a very well established brokerage based in the City of London. We've been going for about 21 years and we're primarily a mortgage brokerage, but I'm a broker on a specialist team that just does bridging and development finance, and we do a lot of regulated business because of where we get our introductions from estate agents, but we can do all aspects of bridging development finance. So looking forward to getting started and getting some insight from you guys, and yeah, I'm excited for the conversation.
Thanks, Laura. Peter?
Hi, I'm Peter Twaite, Sales Director of Synergy Commercial Finance. I think the 20 years is a common theme. I was 25 years in commercial banking and was lured out of commercial banking to help the AFS Group set up Synergy 5 years ago. We're an independent network of 75 brokers that operate nationally, and we've got a small packaging team up in York and a residential mortgage business over in Manchester as well. So really looking forward to the debate today.
Thanks a lot, Peter, and thank you to everyone for your time today. It's going to be a great conversation. So we're going to jump into our first topic or subtopic for the morning, and this is around the distinctions that need to be made when underwriting these two products. What should brokers be aware of when putting these schemes, these types of schemes to lenders, and indeed what do they have in common as well? Sam, if it's okay, I'll start with you on this one.
I mean, I think sort of the main thing to get across is with these types of projects is obviously they are very sort of bespoke. They're not like your standard bridging type of deals. There's a lot more variables to them, more complex. You know, it's more about understanding, you know, the people that you're dealing with, who they're using, you know, sort of professional team that they've got around them, what sort of experience they have. We like to focus a lot on the person rather than focus more on the property. Obviously, the property is important, but you know, quite often we can get a good applicant, borrower, who can make a success of a property that perhaps somebody else couldn't. And you know, when we like to, you know, build those sort of relationships with those type of people and back them, you know, it's a, you know, a partnership thing with us. So it's just, you know, yeah, it's focusing on, you know, there's a lot more due diligence on these types of loans. You know, the more complex, you need to very much look at your terms, your costings, whether they're realistic. You know, do you give some wriggle room in there if things do go wrong, if there's some delays or cost overruns? You know, what's the exit strategy? How are we going to get repaid? You know, things like valuations, they're not the same as just doing a standard valuation. You know, you're looking at this, you know, the end value, you look at the costings, you look at residual value. You know, they cost more money, take more time to do. You know, so it's just really an appreciation that they are much more complex than your standard bridging. I don't know whether, you know, any of the other guys have anything to add to that, or, you know, from their own experience.
I think the thing that I would add to that is that in order for these projects to be successful, it is really the customer and the lender and the broker, to be fair, at the start and sometimes all the way through. It's the customer and the lender, obviously the broker, that are forming a partnership to see these projects be successful. It's not just a question of putting a case into a lender, they underwrite, the deal gets paid out, and that's it. This is a relationship that a deep relationship's got to form to make a success of these projects over, you know, sometimes a 2-year period. The lender has got to trust the customer has got to trust the lender, the broker's got to trust the lender as well, because they're putting their customer, their client, with that lender in order for that customer to make a success of the project. And if that relationship doesn't work, and that relationship isn't embedded and embedded properly at the start of that journey and start of that project, and things unwind, it can destroy value for everybody. So you know, actually, I would suggest that the customer or the broker choosing the right lender is just as important as the lender choosing the right customer. Okay, because at the end of the day, it is a partnership. You know, the customer is effectively the custodian of the lender's money for these projects, because the lender will be putting in the majority, in many cases, the majority of the money. The value will fall before it rises on the project itself, and therefore the lender's got to trust the customer that the customer can deliver on the project and the customer's team can deliver on the project. In addition to that, the customer has got to trust the lender that the lender is going to be good for the money for the duration of the project, and that if something goes wrong during the project, and you know, in many cases on developments it does, because there's, you know, something unexpected that comes from left field, right field, wherever, that the lender is going to be good for supporting that customer when additional support is needed. So from our point of view, actually the relationship is very, very important. Always the customer, the broker, and the lender.
Thanks, Scott. Go on, Dave.
Sorry, I was going to say, I think Samantha answered that question perfectly. You know, there isn't any more commentary you can add to that, because you know, the factors are what they are, and you know, there is many factors that go into the equation. But I think Samantha answered it brilliantly. And going on, you know, from what Scott says, and I wouldn't talk on behalf of the other panelists, but I'd say as a broker, our job is to protect the lender as much as it is the client. So, you know, the lender relationships are just as important for us as they are the client relationships. And Scott's absolutely right. It's finding the right lender, you know, depending on what the variables are within the transaction. Is it leverage that they need? Is it speed that they need? You know, there's a whole host of factors that go into any development transaction. But we've also got to make sure that we protect that lender, because if you've got a client, you know, and we all come across them, these clients that jump from doing a small scale development and all of a sudden go from a 20 unit development and the next project's 140 unit development, then, well, unless there's a substantial JCT contract and there's contractors in place that can deliver it, you can't just jump from a 20 unit build to a 120 unit build and expect the lender to go, well, here's your cash. Because you've got to demonstrate that you've got the ability to actually go from the ground up and complete that whole project. And as Samantha rightly said, the exit is key. Absolutely, exit is key. And these big multi-unit schemes, they're under everybody's radar right now. Everybody's looking at them, and lenders are really nervous about them. So it's a tricky market that we're in, but you know, the lenders, you know, thankfully there is lenders out there that will do these schemes, but it's our job to protect both lender and client and make sure that both parties can work alongside one another.
Laura, is there anything you'd like to add about this idea of matching the correct project to the right lender?
Yeah, I completely agree with Dave. I think you've got to match the client with the right lender. We obviously, as a broker, we work with these lenders day in, day out. So we know what their appetite is. Obviously, an experienced borrower and a really strong scheme, you're going to have the pick of the market. But if you've got a less experienced borrower who maybe hasn't had, 3-4 ground up projects under their belt, that's going to be more difficult to place. And I think there's so much more involved from the broker's perspective compared to a straightforward bridging transaction. We have to support the client a lot more. We need to go through the costings, we need to go to site visits, etc. And as Dave said, lender appetite has changed quite a lot over the last 12 months, and lenders are really looking at demand for the end product. And things that were quite popular before, very robust, let's say a block of flats in somewhere like Croydon, which we would have been able to place with almost any lender. Now they're looking at it thinking the market's saturated, because people's tastes has changed and people are looking to get out of the cities, and so they're looking a lot at the exit, and obviously that's impacted by longer sales periods, issues with refinancing, lack of income or reduced mortgage LTVs. So all of these things, as Dave said, we need to look at matching up the client with the right lender, because no two deals are the same, and also making sure that the client can exit. And if they can't exit, how can we support them by either arranging, a developer exit product or, a buy to let. So I completely agree with what's been said.
Thanks, Laura. Seeing as Laura's brought up the appetite question, Peter, would you like to give us a quick, I suppose, précis of what you're seeing in terms of lender appetite for these two products?
No, absolutely. I mean, the market has definitely woken up in terms of interest in both areas, and we're seeing good levels of appetite, particularly after the initial the COVID outbreak. Obviously, a lot of funders were struggling at that particular time, but yeah, increasing appetite. I'll just echo, it's very much about the broker working with the individual and getting a good understanding of the expertise and experience, and working with them about their perception, because they do believe that they can get the finance relatively straightforward, but the reality can be quite different. So yeah, a good range of funders available. I don't think the high street are particularly open to business, which puts us into the alternative markets, and like I say, there is good strong appetite there.
Scott, on that then, about filling the gaps that have been left for quite some time now, but obviously exacerbated by the events of last year. What sort of responsibility as a specialist lender do you feel to fill this space and to do your best to serve borrowers?
Well, it's interesting that the first thing that we found is once the mainstream lenders did start downsizing their teams, actually that represented huge opportunities for niche specialist firms like ours to take on good talent. Okay, so we've been able to recruit really good quality people from the high street lenders who have been fantastically trained, have fantastic experience. Often they've not been given the responsibility in terms of be able to make these deals happen. And I found that, or we found as a business, that one of the reasons why they come to a specialist lender like us is, apart from the fact that the mainstream banks have been downsizing their teams, actually, even if they weren't somebody that was going to be downsized effectively, that they've had enormous frustrations at these bigger lenders where they've seen really good opportunities and really good deals, and they haven't been able to back customers where they've known that deals have been good. So they come into a business like ours, and they're given, I wouldn't say free rein because that's the wrong thing to say, but they're given the opportunity to make things happen. So where they want to take a commercial view on a transaction because of X, Y, and Z, in an entrepreneurial, nimble, dynamic business like Roma, and there are others too, but in an entrepreneurial, dynamic business like ours, those people are able to make decisions that they were never able to make in the bigger businesses and the bigger lenders. And that means that the customer ultimately is the one who benefits, because they get quicker decisions, better decisions with people that will back them in those projects. And so so are bridging lenders filling the gaps left by those providers that have attracted? Absolutely. But what it's also done is it's given career opportunities to people that have not had the opportunities to really be decision makers, as they've been much smaller cogs in much bigger wheels. They come into our business, they're a bigger cog in a smaller wheel, and actually everybody benefits, including the customer.
Scott, I hear what you're saying, and again, I suppose it's where the broker needs to step in. But we do have funders out there that are operating in the specialist space, but treating the client like a high street client, and we do that nimbleness and you know, to shape a deal, and not for a specialist funder to per se operate like a high street bank where there's a lot of constraints and a slowness about the procedure.
That's a really good point, and actually it's therefore, I think, incumbent on the lender to put their staff out there, and it's incumbent on the broker to get to know the people within the lender, to know whether those people are capable of making those decisions. Because actually, if you go to a specialist lender and they've got all this bureaucracy, the customers no better off, the brokers no better off than they were dealing with the high street. You know, I remember when we first started, you know, 11, 12 years ago now, one of the first things that was said to us, well, we're not going to use you because you're too small. But actually, small can be beautiful, because what small does is it enables the decision makers to get closer to the customers. And so again, it goes back to the relationships. You know, if you've got quality people that you're happy to expose directly to customers, they will back those customers. And listen, you know, we're now not a small lender anymore, but what we've done is we've maintained that flat structure that allows people to make the decisions they need to make in the time frame that they're able to, that can make those decisions. And you know, as we've grown, so we've allowed people to, we've grown individual people's mandates so that they can still make those decisions and quickly, and we've broadened the mandates to enable, you know, to see more, you know, more junior talent come through the business, and they can grow as well and grow their careers too.
Thanks, Scott. Kim, just coming over to you, would you be able to isolate some of the common areas when introducing this type of business that perhaps brokers and perhaps lenders trip up on, or things to watch out for, some of the common pitfalls?
Yeah, so when it comes to heavy refurbs and developments, it's already been picked up. There's certain key areas that need to be addressed right at the outset before a lender's even chosen. For brokers, I guess it's really knuckling down on cost of works, making sure that the clients have included contingency, professional fees, because it's actually surprising how many cost of works we get across that don't include that. Property CVs go a really long way, and for some reason getting clients to do that sometimes is quite tough. You get like a one-liner and it's kind of like, give me something here to work with, because lenders love that. It gives a great background into what they've been doing. So we're trying to educate our clients as much as possible with developments and heavy refurbs to get their kind of ducks in line, including all of the cost of works, including the CV, because first impression is everything. We often see it, and I'm sure Scott and Samantha and the rest of the guys on the panel and Laura can kind of chime in on this, is that we do often see where clients are going to multiple brokers and lenders are seeing the same deal land on their desks so many times. So again, it's just advising and educating clients that whilst they think they're doing a good thing by going to different brokers to try and get the best deal, the chances are, you know, a broker that's worth their weight in gold, they'll be sourcing the right deals for them, and it's not a one size fits all. The trust element for us at Vibe, we might have some fantastic relationships with lenders that other people like Dave and Laura might feel differently. So it's trusting the broker, isn't it? And it's trusting the lender, and it's yeah, just not touting those cases around. So there are definitely elements that brokers can pick up on and educate clients before it even hits the lender's desk.
Sam, from the lender point of view?
Yeah, well, I'm sort of picking up on that. I mean, we've seen increasingly where, I don't know whether it's the broker or whether it's the borrower, possibly a combination of both of them, where they don't seem to look at the longer term picture, the bigger picture. So when they sort of perhaps see a property they want to buy, you know, it may be a commercial one or something, and they're thinking, like, I'll get planning, you know, I'll convert it to resi, you know, get development finance, but, you know, whatever. They'll just focus on that initial purchase, say, right, what maximum I can get. They don't then think, well, right, once I've got planning and I need development finance, how am I going to do that? Because obviously we have different criteria, we have to, the risk profiles completely different. So, you know, we can't max out on day one at 75% or something. We're then going to be asked 100% from the works, because it just, the figures just won't work. So we've seen quite a few instances where, you know, on day one, they've got to find some cash to put in to pay the existing lender, or they need to throw some extra security. You know, we've got to gear up on other assets. So we see that quite a lot, where they're just focusing on the here and now and not looking at what they're going to do further on down the line and how they're going to do it. So that's something we're increasingly looking.
Peter, what are your thoughts on current and prospective supply chain issues in relation to what happened last year, what's continuing to happen in relation to COVID, and then as well as the Brexit effect on these types of projects?
Yeah, it's an interesting question. In terms of funding supply chain, or supply chain of property?
More materials based. We understand there's going to be huge hikes in costs as well as delays. So.
Well, personal experience of Nick Simpson, our MD, who's just developed his own house, supply chain issue, it has been incredibly difficult. It's put his project back by 3 months, and certainly trying to locate parts for windows or ground source pump or whatever, it's been incredibly difficult. So I think as a world we're getting our head around you know, certainly the current situation of COVID, and supply seems to be returning not to normal levels. Brexit again is a significant issue as well, with supply chain issues. You just have to watch the news, and you can see that you know, delays, reduced sort of sales are happening due to Brexit. So I think it's going to be a bit of a bumpy ride for the foreseeable future until we see a more regularised sort of market come along. But yeah, supply chain issues have definitely been, you know, personally something I've seen as a significant issue.
Laura, what sort of contingencies would you be building into applications at this point in relation to those possible delays and shortages?
I would say that it depends what kind of deal you're looking at, because if we're looking at a heavy refurb where, for example, they're converting commercial to residential, you might be able to get away with getting the materials from the UK, especially if your build costs aren't super high. But on a ground up development project, you really are probably going to need to source your materials from Europe, just because otherwise it's going to eat too much into your profit margins. So we're kind of suggesting to clients and developers to order the materials as much in advance as possible, although obviously we can't forecast what kind of delays they're going to experience when, you know, the materials get stuck at Calais, or, you know, the shipping is just delayed. But I think lenders are really factoring that into their models, and they're understanding now that actually the client might not need an 18-month term. They're going to need a 24-month term, and maybe they might even need longer to sell, etc. So I think initially we had the first lockdown where obviously construction sites shut down, and that's created a knock-on effect, just a lack of labour force. And as well, you know, Brexit's having an effect on the lack of labour force, because we were using a lot of workers from Europe and they're just not in the UK now available for building work. So that's so all of it unfortunately is contributing to delays. But I think, you know, as brokers and lenders, it's up to us to support the clients, make them aware of these things. You know, most very experienced developers are already going to be aware of these issues, and just see how we can kind of create a contingency whereby the term of the loan is extended, and you know, help the client on the other side with extensions, etc.
If I can just add to that, I think that you know, one of the things that, you know, I think that specialist brokers can factor in, particularly after COVID, was how lenders have behaved during COVID. So, you know, COVID was a nuclear missile that came out of left field that nobody expected. Okay, some lenders have behaved very well. Some lenders have behaved not so well. And you know, I think that it's important that brokers, you know, choose a lender that is there to help the customer and has proven to be able to help the customer when a nuclear missile comes in from left field to kind of scupper or derail the project. Because you know, how a lender behaves when the chips are down actually is just as important how a lender behaves when the chips are not down. You know, choosing a lender that's a supportive lender, that, you know, even if they're not a regulated lender, behaves like a regulated lender, actually will be the determining factor ultimately as to, number one, whether the customer makes a success of the project in the end, but number two, whether that customer will go back to that broker with the next deal because they've chosen the right lender for them and their project. So there's a response. It goes back all the way to what we were saying at the beginning, all of us, that the relationship between lender, broker, and customer is absolutely key, and the understanding that people have got of the strengths and weaknesses, to be fair, of all lenders. That knowledge, that specialist knowledge of specialist lenders and specialist brokers to help customers who, at the end of the day, pay all of our wages. That's absolutely key.
I totally agree with you, Scott. The conduct of the lenders is absolutely fundamental, not only for the client but for the broker reputation with the clients. And yeah, it was quite interesting when the pandemic hit on the responses of some of the funders out there, and that I was incredibly surprised at. So yeah, totally. It's
100%. I mean, just by way of what we did, and I know this is not supposed to be a plug for us necessarily, but I just want to just explain what we did. Every single one of our customers who was impacted by COVID got completely fee-free extensions, completely fee-free. Nobody was charged a penny for something that was not their fault. And we took the long-term view that actually, if we behave in the right way now, this will actually determine whether we're a successful business in 2, 3, 4, 5 years' time.
I think that, Scott, I'll just underline it, because I think that's a brilliant approach that you took on that, because we've seen some real horror stories. You know, we had the CBILS developer exit products, and that money was going out the door within 4 days. People had pots, UTB 200 million quid. It went within 4 days, but the scheme had to be 90% complete. We know the criteria for it, and it was a brilliant product. You know, the British Business Bank need a pat on the back in some degree for it. But the lenders on the flip side of it, they were willing to just do a 5% renewal default interest rate fee, flip them onto 2.5% per month, knowing that, you know, we've got a developer that his whole workforce is Polish, and they went to Poland and he couldn't get back to the UK. What's he supposed to do? But yet straight away 5% renewal fee. That's it, default interest, 2.5%, and no negotiation point whatsoever. If his whole workforce is trapped in Poland, how the hell can you, that lender's mentality of, how do you expect that client, that developer that's done 6 projects to come back to you as a lender and do another transaction with you? You're never going to deal with that lender again as a developer.
No,
it's just crazy.
So one of the questions should be from a customer as well as a broker, you know, what did the lender do during COVID? How did they behave during COVID? Because listen, you know, it's hopefully we're kind of the lights at the end of the tunnel, we can see our way out of it, but going back to how the lender behaves and how supportive they are of that customer and that project, actually that's key. This development finance is about enabling customers to create wealth for themselves and their families. And if the lender's taking all the customer's equity out of the project, ultimately, okay, so the lender makes a bit more money, but they'll never get a client again, and actually they'll never get the broker again. And business is about the long term. Always, it's about the long term.
Can I just add very quickly into that as well, just to touch upon what Scott said, because it's so key. And just as an example of this, we had a client yesterday that we arranged the exit for, and they completed away from Roma. And first impression is everything for clients, and so is the last impression. And just to touch on what Scott said, the way that Roma acted, the way that you extended it, you're flexible, you waived certain fees. The last point for me is that they turned to me yesterday, and there's only one lender that they now want to work with, and it's Roma because of that. So And also what Dave said, there's been some lenders that have not acted and conducted themselves well throughout COVID. And it's not just the clients that see that, it has an effect on the brokers, because I can tell you now, if one of our clients has been unfairly penalised and treated in a certain way, will we be placing those cases with them going forwards? Because we are still in this a bit unknown period. Yes, the light is at the end of the tunnel. But yeah, just to reiterate what Scott said, it's really, really key.
It's key for the broker too, because the broker, if you look after, if your customer is treated well, that customer will come back to you time and time and time again because they trust you. And if the lender you put the customer with doesn't behave properly, then actually you as the person in the middle, you the broker, you're the one that gets it in the neck and gets your ear chewed off by the customer. So absolutely, and people need to have long memories to understand how lenders behave during the last 12 months.
Thank you. It's amazing how often these conversations circle back to that particular nuance. So thanks for that. I just wanted to get a little bit more specific about the assets in question that are contributing to the surge in the heavy refurb. So I'm looking at planning changes that have happened, looking at the work from home effect. Laura, would you like to just give us a bit of insight as to what you're seeing from an asset point of view that's particularly suited and surging in this market?
Yeah, definitely. I think at SPF we work with a lot of property professionals, so property landlords, and we're finding with the inevitable delays in sales periods that landlords are now looking at more, and property investors and developers are now looking at more kind of creative ways to generate income from the assets while they might need to hold on to them for a bit longer. So we're seeing them maybe turn a single unit into flats, and obviously applying for planning to get that, or turn it into a HMO just to maximise the rental yield. From like a regulated perspective and like an owner-occupier perspective, we're kind of seeing the opposite. So people who were very sort of zone 1 and 2 centric and now looking at, actually I would quite like to move out of central London and have somewhere with a bit more space. So they might be looking to apply for planning for, let's say, you know, a rear extension or a side extension, just to add a bit of space to their home, maybe create a home office. A lot of it can be done under PD anyway. Unfortunately, in the regulated space, we haven't got that many lenders at the moment with an appetite for what we call heavy refurb. A lot of them withdrew from the market last year, and we haven't seen the appetite come back. And I think that's just because the 12-month time frame for a regulated bridge is very restrictive in terms of completing the works and exiting. And obviously I'm stating the obvious by saying that the demand for office and retail space has massively dropped off. So the owners of those buildings are going to be looking to develop those properties within PD. So we're seeing a lot of that. But to be honest with you, I've been seeing a lot of permitted development for a while now, even pre last year, like since I'd say like 2015, 16, I've been seeing a lot of it because, you know, death of the high street. And I think corporations are realizing now, actually, we don't really need a Pret on every single corner of every single street if people are working from home, you know, 3-4 days a week. So I'd say those, from our perspective, those are kind of the areas that I would say are contributing to the popularity of the heavy refurb products. And we've got so many clients at the moment who are going through planning, looking at doing those kind of projects. So I don't know if the guys would agree, but that's what we're seeing.
Totally agree, Laura. We're seeing an awful, you know, we've got one, it's a big retail newsagent's head office that we're doing, and it's a big office block that's being converted into a residential scheme. The problem you've got, and you all know, you encounter some really strange and wonderful things on these transactions. Telephone masts, they're a bloody nightmare. So trying to get, you know, telecommunications companies to agree to move a telephone mast when it's stuck in the middle of a site. The site's brilliant, but you've got this horrible eyesore right in the middle of it, and it's an 18-month move. But yeah, we're seeing so many conversions of offices that I'm going forward. You know, what a city centre is going to look like? That's the big question. What is a city centre going to look like post-COVID? It's going to be such a strange place to be. You know, Birmingham's like a ghost town during the day at the moment, and is it going to get to that normality of, are we going to have the same footfall of people going into work, as Laura rightly said? I don't think we will. I think this working from home, 3 days in the office, 2 days at home, I think it's going to continue going forward. It's It's going to be interesting space to watch.
So Dave, from your point of view, how do you see the repurposing of town centre, city centres over, say, 5 or 10 years? What's your view, obviously, as a Birmingham city-based business?
Well, I read a piece and it was really quite interesting. If you look at the likes of places like Debenhams, House of Fraser, etc., do they need 7 floors of retail space? Probably not. So what they're looking at now is going, do they do 3 floors of retail space, a floor of leisure, and then 3 floors of accommodation space? So therefore, all of a sudden, you've got what was a full retail unit that occupied prime city centre location in Birmingham. It still has its retail footfall. It doesn't require the square footage that it originally required. Then you've got a nice bar restaurant space, and above it, you've got some nice apartments. Whereas, the apartments sat where, where the ladies' clothing and the men's clothing department used to be, but they don't. They can just be more creative with the space that they've got, and I think you'll see more of that. I think you'll see more of that. The leisure space splits the retail to the accommodation. It's quite. Yeah, it's going to be really, really interesting to going forward to see what the city centre is going to look like.
Yeah, and I suppose finding customers and borrowers and lenders that have got that kind of vision as to how the city centres can be repurposed over 5 or 10 years is going to be one of the important things too, because I'm not sure yet that everybody has got that, can take a long-term view.
I agree. We've had some really strange commentary from lenders as well. Throughout COVID, everyone's gone about outdoor space. Everybody wants the outdoor space. Well, that's brilliant if everybody can afford outdoor space. The sad thing is, what you've got to cater for is the fact that not everybody can afford a house with a south-facing garden. Outdoor space is only good if the sun shines on it. It's, nobody wants to be sat in a north-facing garden in April when it's freezing cold. It's, you want the sunshine. Well, we have only got so much space to build in this country. We are building on brown sites at the moment. So you can't build on green belt. It's everybody, of course, everybody wants a house with a garden, but sadly, not everybody can afford a house with a garden. So I think developers are getting really, really creative with the outside spaces in these multi-apartment blocks now. Everybody's conscious that this living space that's required in this fresh air that people need, and it is purely down to COVID that people crave it. But again, COVID will be something of the distant past in a few years' time, hopefully. And that's when the city centres will start to boom again, I think, from an accommodation point of view.
And I think interestingly as well, under the PD scheme.
In April, drinking a pint, that's luxury, isn't it, nowadays? The thought of being able to spend time in other people's gardens. So I absolutely agree with Laura. We've seen lots and lots of conversion, and pre-COVID as well. So we've done a number of works in terms of converting old police stations, office blocks that banks have occupied in the past. So we do see a drive to that city centre repurposing. And my old hometown of Hull, the House of Fraser has done exactly what you've described, Dave. Downstairs, food hall, small amount of office space on the next floor, and then just residential above it. So I do see that continuing. It's just what the demand is going to be like in terms of people wanting to do that, because there is a lot of office space that I frankly see will not be occupied going forward again. So it's just the demand of individuals buying that type of property.
And I suppose that's also one of the great things about the changes to PD as well, in that you've got one of these buildings and you can put another 2 stories on top, up to 18 metres high, for additional residential space. And I think it was Dave that said these properties are in absolutely prime retail, prime city centre locations, and they're perfect for residential people that want that or need that, particularly young people and potentially even older people as well moving forwards, because the mobility issues in town centres often is better than in suburbs.
We've just had a question come in regarding it's COVID related, but the question is about the impact on HMO finance with COVID and social distancing considerations in place, if not legally, maybe sentimentally for the future. Scott, what are your thoughts on that?
One of the great things about HMOs is that you've got a high yielding property where at the moment in particular the cost of debt is cheap. If you've got a high yielding property, the cost of debt is cheap, and with an HMO, one of the great advantages of an HMO is that if one of the units or a small number of the units are not occupied, the property is still yield enough to service the debt. And so HMOs are actually incredibly attractive from a lender's point of view because the risk of default is far lower than a single unit buy-to-let. In particular, as a result of, I'm presuming you're talking about the long-term HMO finance rather than the short-term to develop the HMOs. And so one of the things that we've seen is there's a moratorium on evicting people, tenants that can't pay. Well, if you've got one tenant in a single unit buy-to-let that's not paying you, and you've got a mortgage as a customer to pay, that could be the difference for you between actually having food on the table and not having food on the table if you're not somebody that's got a lot of substance behind you. But if you've got an HMO and you've got one tenant that doesn't pay, actually it's not the end of the world because you might have another 7 or 8 that are paying. So we see the higher yielding HMOs as particularly, it's got to be obviously around the right location. So near to lots of facilities, hospitals, universities, schools, transport links, those types of properties, and also for example near construction, major infrastructure projects. So it might be, for example, that the free ports that are going to be created around the UK, there'll be a big requirement for contractor accommodation, which will typically be in HMOs. So again, those things from a lending point of view, all you're trying to do as a lender is de-risk your position so that you've got a good customer in a good property, and you can go forwards. And so those are the ways in which, from our point of view, we look to de-risk those deals.
I think you mentioned earlier, Scott, and perhaps both yourself and Sam can chat through this briefly about your variety of funding and how that has facilitated committed lending over this period. Would you like to elaborate?
Yeah, Sam, I'll take this one and I'll let you finish off with pleasure. So I'm not trying to steal your limelight. We've developed as a business a deliberate strategy to have a very, very broad range of different funding lines, because we never wanted to be in one lender's hands. And we've seen, particularly during COVID, that some funding lines withheld and changed the goalposts on lenders, and that meant the lender, no matter how good their intentions are, had nowhere to go. So by having 8 funding lines, we knew that we were de-risking our business, and we were de-risking the business on behalf of customers and brokers too. And I think that's been a good strategy. So again, going back to what we were saying about brokers understanding the lenders that they work with, I think brokers understanding how the lenders are funded is just as important as understanding what the appetite of the lenders is, as well as understanding how they behave, because you might find that it's all interlinked. So getting that deeper level understanding of the people and the businesses that you're working with, it's just as incumbent on a broker to understand a lender as it is on a lender to understand a broker, and a lender to understand the customer, and so on and so forth. So actually one of the key questions is, tell me, Mr. Lender, how are you funded? Where does your money come from? Who backs you? Where does your backing come from? And what you'll tend to find is that the lenders that are solely institutionally backed, high street backed, their funding fits inside a square box. The lenders that are, but that will generally tend to be the cheapest form of funding, because their cost of money is the cheapest, but the flexibility is the least. Whereas on the other hand, those lenders that are funded, say, through either equity or simply through family offices, their cost of funding will be the most expensive, but they'll probably have the most flexibility. Okay, and so actually, but just finding a lender that only has one or the other actually is no good from a customer's point of view either, because you just don't know when the taps will be turned off. I mean, you take, for example, going back 12 years, and again, with the exception of perhaps, actually, I should say, with the exception of perhaps I don't know, Laura, for example, who's a lot younger than I am. Most of us have got long memories as to what happened from the global crash 12 years ago, where even Northern Rock went out of business. Lehman Brothers went out of business. So if you were a business or a customer that was backed on a project by Northern Rock, all of a sudden that money disappeared. There was nothing that you could do, you know, we saw how certain institutions behaved towards lenders during COVID. Those lenders had nowhere to go. So finding a lender that has a broad range of different funding sources, debt, equity, institutional funding lines, family offices, high net worth, PE, VC, whatever, actually is really, really important from a broker's point of view and from a customer's point of view as well.
Kim, what are your thoughts on the funding question when looking at a project specifically of these types?
Yeah, I think it's really important. We've seen lenders just withdraw from the market, and we've got developers that have been burnt by that. So what Scott has said is really, really key, actually. It's really important to know where they stand financially and how secure, because like we've said on this panel, you know, these developments are taking sometimes 15, 24 months. That's 2 years potentially. And it gives you a better insight to see how secure that might be in the future, which is really key.
Thanks, Kim. We've got another question here, which I think I'll pass on to Sam, if that's okay. The question is, with difficulty in predicting sales prices and issues securing land at reasonable prices at the moment, are more SME developers holding off from ground up developments until they can see more stable profitability prospects?
I think from what we're seeing, no, they're not holding off. No, there's a lot of interest. We're getting lots of inquiries, particularly from the smaller builders round up. No, they're definitely not holding back. And in fact, we have internal relationship managers and asset managers who go out to sites, so sort of to relay, to see existing sites. And a lot of the schemes that are actually coming to the end, they're actually finding that sales are really strong at the moment, and they're actually achieving higher sales prices than what the values originally predicted. Now, whether or not that's set to continue, obviously we don't know, and it's one of these finger in the air time, I suppose. But I think most, what we can see, are really keen to get on with doing ground up, and they're not holding back at the minute. Not in our experience, anyway.
Thank you very much, Sam. We've got 2 minutes to 12, and I'd just very much like to do a quick whip around the panel to see if anyone has any closing remarks that they'd like to add, and also to thank you all very much. Peter, can I come to you for any closing comments?
No, really interesting debate. Thank you very much. I suppose just a play out to the funders, just to keep a weather eye on the loan to value, loan to cost side of things. Certainly we didn't get onto the mezzanine funding side because a lot of the mezz funders are getting a bit nervous about the fact that they're being asked to plug the gap. So yeah, just a play out to you guys, just to make sure that you're not paring back the loans too much.
Thanks, Peter. Dave, final thoughts from you?
I think Peter's just made a really, really great point. I think that is, loan to GDVs and loan to cost. We are seeing a cautious approach from lenders at the moment, certainly on the bigger the schemes. But the bigger schemes, obviously, that's what we need the help with, because that percentage difference of 5% in loan to GDV can be millions and millions of pounds up front from the clients. So yeah, I would reiterate that. I think it's been a great debate, really useful insight. But obviously, the calibre of people on the actual call, I think testimony to the broker market that we operate in.
Thanks very much, Dave. Kim?
Yeah, no, it's been a great debate, and besides what Peter and Dave have said in relation to the cautious approach, I think it's really important to note that there are still so many options out there still, which is great. The position we're in now, going back to 6 months ago, is a positive one. So like we've said, developers are kind of going for it at the moment. They want to add value, and it's just nice for us brokers that we've got more options. So yeah.
Long may it continue. Laura?
Yeah, I'd agree with Kim. I'm feeling very positive. If you compare where we were in March with development lenders, you know, massively capping their loan to GDV at sort of 55, 60%. I feel like we're back at where we were before at sort of 70% for the majority of deals. And so as Kim said again, like developers are very active and they're looking to undertake more projects. Obviously, we're really happy to support that. The government seems to be on board with the build. Obviously, I think there's more work to be done there. The incentives there to kind of encourage developers, but whether it's actually translating into the planning being easier, I'm not quite sure. But I'm looking forward to seeing, you know, how the 95% mortgages which are coming in April are going to, you know, inject a bit more activity into the market for kind of first-time buyers, that kind of thing, and help, you know, selling properties, and also the extension of the stamp duty holiday. So I'm feeling pretty positive about the rest of the year.
We're going to need a whole another hour to talk about the closing remarks. Sam, anything final from you?
Yeah, no, I mean, I'm saying again, we're really positive about the ground up and heavy refurb. We're getting lots of inquiries. It's only going to get busier from our point of view. You know, we're dealing with some great brokers. You know, the more they're educated and they educate their customers, you know, as to what the requirements are, you know, what the risk is, and how you know we as lenders will view things. You know, I've done property sort of investment myself, and I go through the due diligence process when I'm looking at stuff, and you expect everybody to do that. You know, when they're looking at things, you know, does it make sense financially? Does it make sense? How are you going to repay it? Look at the worst case situation, you know, as well as the best case, and just, you know, it's just being realistic with things, and just make sure that they're honest and open about things. Because, you know, we have flexibility, we can work with people, and it's just about communication and building long-term partnerships. Really, that's all that we want. Make us happy.
Thank you so much. And Scott.
First of all, I just want to thank everybody for being part of today. Karen, thank you for setting it all up. Kim, Laura, Peter, Dave, obviously Sam as well. Thank you all for taking part, and for the people that have listened, I hope that you've enjoyed it. I've found it thought-provoking and interesting. From our point of view, just to reiterate what I've said before, relationships and understanding of customers to brokers to lenders, relationships absolutely is the key, because understanding our customer and what their objectives are is the key for us to being able to structure a transaction which works for that customer for the long term, for their project to be a success. It's obviously rate is important. It doesn't just come down to rate, it comes down to relationships. And I also think that there is a huge responsibility on lenders to provide education. So, you know, incumbent on us as a business is helping our introducers, our brokers, to understand us and our business, what types of transactions we're looking for, how we're going to structure them, and ultimately how we're going to help a customer. Because at the end of the day, what I said before, it's a customer that's paying all of our wages. How we can help that customer to make a success of that project that they put to us. Because what we want is the customer to be not just coming to us for the first transaction, but to be with us in 2, 3, 4, 5 years time after having had, you know, X number of successful projects. That's ultimately what we're all here for.
Thank you, Scott, and thank you very much for partnering with us on this particular roundtable. I thought it was an excellent conversation. Thank you to Laura, Kim, Peter, and Dave. Sam, Scott, it's been an absolute pleasure. And thank you to everyone who tuned in. If you have additional questions for the panel, you can pop them over to us and we'll pass them on. Our next one is next week, Tuesday, on the 23rd, and people can register to attend and join in on these on a weekly basis via Bridging and Commercial and Development Finance today. So thanks again, and have a wonderful rest of your day and afternoon.